Greetings, ladies and gentlemen. I am TomPow, and I'm here to join you again today after a 2-month hiatus. Back in July, we had an FOMC meeting where my colleague, Chairman Jerome Powell, informed the media of a 25-point basis increase. This would be the 11th such hike in the cycle. We did have a brief pause in June. However, what happens today is a mystery. Markets are pricing in a 98% chance of no interest rate hike. This would go against what my colleague Powell spoke about in July. Without further ado, we will welcome Mr. Tom Crown. Well, hello. Well, hello, fam. I was a little disheveled there. Didn't mean to start late, but we're here. We only have 4 minutes at this point, 3 minutes at this point. Sorry. Until the interest rate decision goes live. At 2 p.m., we will get the rate. For whatever reason, it's published to the news media outlets first, and then at 2:30, Chairman himself will speak, and fingers crossed, we will get a Gina sighting. Smash the likes and subscribes. Share the stream for Gina. It's for Gina, fam. We can't do it without Gina. That's right. So at 2 o'clock, we have 3 minutes, guys. Typically, we're already live by now. Typically, we're been live actually for a little bit. We're a little late, but here's what we're going to do. Like we do every FOMC, one of our traditions is everyone pull up a tab on Google, Bing, Yahoo, wow, what's going on with my lighting? Okay. Yahoo, Bing, whatever it is. And we're all going to Google the interest rate decision, and please put it in the live chat when you find it with a source. Reminder, no source before 2 p.m. is valid. They don't have the answer. It's just clickbait or phishing after 2. So sort by time, etc. And we're going to source it here first. Then we're going to have about 30 minutes to go through some charts to look at some things like Bitcoin, the dollar, what's happening, what's going on. It's going to be a spicy day, guys. So sit back, roll them if you got them, crack a brew. It's Wednesday, and it's Chairman time. I'm ready. Are you ready? I hope you're ready, because there's no turning back now. It's already too late to turn back. I hate to say it. All right, here we go. Yep. 2 minutes. We got a poll going. Please vote for your favorite Chairman name. We got over 500 viewers. We only have about 100 likes. Let's get that up to 420 minimum. But let's get ready to Google. We have just over 1 minute now. What's up, Alex Reyes, Alex Wells, Apis, Research, BG, Badger, Bathwater Basin, Brendan, Bayuman, Geeser, Chocolate Wee, Clint Down, and Coca-Cola Coins, Check, Cryptid, Crypto 420, Crypto Shaped, Crypto Corvette, Cryptogenic Dude, Cryptogenic, Darko Disc, DJG009, Eric Wallen, Trade and Tread, Phi, FOMO Sapien, Jason Caitlin, JC, Joe, John Doe, John Foster, Crypto, Jonah Copernicus, Captain Kurt. Who else do we have? Kelly Boy, Keyman, Crunk C, Lazarus Hand, Lee Cable, Loading Name, Lolek, Market M, what's up, Michael H, Mike Vollmer, Mercia Bondoc, Mohammed. What's up, Mohammed? And Mr. Andy Walk, Mr. Techno Goody, Nate, NBF4. I'm doing this too fast. Nick Young, Nomadic Life, Powell, Draws, Peter Hediger. They're updating so fast I can't even see them. Holy, everyone's showing up today. I love it. Raven Song Records, Randy Abgett, Psychedelic Astronaut, Prolific Joints, Prof Freak. We got Rave Song Records, Redman, River, Rolling 69ers, Rubik's, Sam James, Sarah Aziz, S Dog, Sino, Shaddy, Strax Gaming, Supamaku, Sven Irvin, The Pickle, The Mad Catter, The White Buddha, Tillin McPooch, Timecone, TJ Fry, Trading Zone, Tusk Reaper Gaming, Vapo Chilled, VZF, Phased Cat. I got almost all of them. If I missed you, you hadn't sent a message yet by the time I said that in alphabetical order. We have 30 seconds, guys. 30 seconds. Enough with the shoutouts. We can get more shoutouts. The only thing I want you guys doing right now is prepping your Google and liking and subscribing. Those are okay as well. You can like and subscribe. Fed interest rate decision, it is September. Let's pull this up. So this is how I'm going to do it. Yeah, I forgot to go over this really quick. 98% chance, according to prediction markets, of no interest rate hike. That does go against what they said in the last meeting. Very odd, perhaps. Very odd to see that. I don't know. Doesn't really smell right to me. All right, get the Googling, get the refreshing going. It is 2 o'clock on the dot. Who's got it? Who has got it? We hear FX Street pause at 5.5. We need another one. Forex Foundry, no change. Are we going? Ooh, it just got spicy. What's up, Domino Crown Plaza? Anuj, Worston Bruged. Zero. What is happening? On this zero interest rate decision, we are seeing the dollar rally. It's a 0.2% in the last minute. We see the S&P 500 down about the same. Bitcoin following suit. That's some spicy interest rate candle, man. There we go. You can see the sideways price action leading into this moment. Stocks are dumping. The dollar is pumping. We're going to zoom out in just a second. Holy, I got to get my bearings about me. Bitcoin, this is my takeaway right now. Bitcoin holding up really well, at least right now in this moment, compared to stocks. We are really seeing stocks take a shit, and we are really seeing the dollar take a little pump-a-roon. The dollar now up 0.3% in the last 100 seconds. S&P 500 down 0.4%, and Bitcoin actually recovering. Whoa, Nelly. Whoa. Recovering here. Let's get rid of these really quick. Bitcoin selling off with stocks on the dollar pump on the 0 BPS change. Yet Bitcoin, we're seeing a little wick on the bottom, and that candle is looking to move. Looking to move. Back to green. I got to tweet no interest rate hike FOMC. Okay. All right, this is really weird. So in the last meeting, Chairman Powell literally said there would be more hikes. He said he didn't see a reason to pause. He didn't even want to call June a pause. He said, I don't, what are the words? He didn't want to call it a pause. I don't know what he said, but just like a skip. So this is definitely a mix up in markets, and we are very likely to see volatility off this. We already got a little bit of the spice. Let's go down to 1 minute really quick here, just to show you the kind of explosiveness of these moves in perspective. Dollar putting on nothing but green candles. S&P 500 maybe catching some bids here as Bitcoin moves back to a green 5-minute candle. That is spicy. Friendly reminder, guys. Today is a highly volatile day, so it is a very risky day to trade. We do love trading here. If you do want to trade and you have to trade today, please remember your stop losses. Please remember risk management. And, if you're going to trade on our sponsors. We've got Fairdesk and Femex, no KYC, up to $100,000 in trading bonuses, deposit bonuses if you sign up with my link. It is juicy. Just be very careful. Links in the video description below. Also, really quick, while we have a second, I'm going to read the chat. I just want to get through this. Discord, join it now. Join the fam. You won't regret it. Last piece of business. All right, last piece of business. This is the last piece of business. Last piece of business is pinned to the top of the chat. There is our first ever long form educational trading video ever published. We've done shorts. This is our first long form. I wouldn't check it out right now because you're chilling in the stream. But after the live stream, definitely check it out. Absolutely. You can find it on the channel page, etc. I'm going to unpin it. I'm going to pin the Discord instead. There we go. Now we got over 1,000 viewers. Hey, yeah, let's go. Can I get a chirpow? A chirpow? A chirpow? A Chairman Powell. Can I get a chirpow? Oof, you degens. He's going to talk toughness. I want to know what you guys think is going to happen today. What is Chairman Powell going to say? I can't put it together in my head. I was literally the one saying at the end of the meeting last month, oh, well, I will say they followed through when it comes to monetary policy pretty closely to what they've said over the past. What they've said kind of in the nebula of economy has been total crap. Inflation's not real, right? That we know that. But when they say something about what they're going to do at the next meeting or what their plan is going forward, they've been pretty reliable. So this is a mix-up. This is not at all what I expected. Even though I saw that 98% probability on the Fed rate monitor, did not expect. I thought we would get a curveball and get like 50 or something. What do you guys think? I'm going to turn on some tunes here, just some chillin' tunes. Some chillin' tunes while the markets decide what direction they want to go. If I can get this loading. Let's go. I don't even know what this is. Let's play it. Let's see. Looking in the chat. Let's see. We out chia. What's up, Erase One? BG hawkish, very hawkish. Ultra Chaos Steve, shout out to you, my friend. You are my friend. It's good to see you. Alex Wells, pause. Juicy. What's up, False Flags? How you doing, man? Digital Asset DJ and Chris Pax. Less hawkish? Or maybe it's eaglish. What is this song? This is like a sea shanty. Can you guys hear this? I guess we're just going to listen to a sea shanty. I don't hate it. It's kind of low energy, though. Dixie is eating it. That's right, B Christ. By the way, guys, please subscribe if you haven't subscribed yet. We have a huge audience today. We are the home of the FOMC meeting. We have been doing these for years. Before anyone streamed them, we were streaming them. It was just us in the Fed, and nobody tuned in. We invented it. And now you found your home for all the FOMC meetings. Speaking of that, I should probably pull up the stream for when they're ready. That would probably be smart, yeah? Ja. Let's see one yet. Oh, wait. Fed. FOMC live stream. Here we go. I got it pulled up. There we are. Oh, sea shanty kind of day. Sea shanty kind of day. Display capture. No, other one. Go. Alright. Alright, give me 1 segundo. Keep it poppin', fam. Keep it poppin', keep it chippin'. There we go. We're now a sea shanty channel, just so you know. We'll only be playing sea shanties 24/7. We're not even going to be looking at crypto anymore. Just sea shanties. All shanties, all the time. More shanties than you can even handle. There we go. All right, I got that pulled up and it's ready. There we go. I funnily ink the first subscriber. Welcome, champ. Good to have you, my friend. Welcome to Crown Town. One of many today, I have a feeling. One of many. All right. Juicy, juicy. If you don't join Discord, you tell him, Steve. You tell him. It'll be unchanged. Nice glasses, Tom. Thank you, Long Mountain. There, you know, I thought I'd try something new. You like the sea shanty? Yeah. Why not? Why not? We're riding the seas of the markets. You listen to sea shanties. What did you miss, Nima? Not much yet. We have, actually no, you've missed a lot already, but you can get caught up really fast. We have a 0 BPS interest rate hike, which is, in my opinion, totally wild card here. Do I agree with it? Yes, I think that's what should have happened. Wild card though, because this is not at all what we were promised. We've been bamboozled by Jerome Powell. And Mr. Chirpow is going to have a lot of explaining to do today. He's probably going to say stuff like, we need more data. Why can't we get this man the data? Who has this data? I don't know. Hopefully we will see Gina. By the way, smash the like button for Gina. The more likes we get, the more chance Gina will notice me. Someday. Gina. My love, mi amore, yar har har, we're sea shanty streams, arr matey. My ancestors were pirates, fun fact. What's up, Brendan? The stream is solely Gina. Guys, I need a Chirpow in chat, but I need a Gina emoji in chat. Give me some Gina emojis. There we go, for Gina. Chirpow is longing Bitcoin. I don't know. He might be longing the dollar, though. The dollar seems to be the winner right now, which is really weird. That's really odd. I've been saying this for the last few streams, or the last few Fed-related streams. The dollar started rallying. If we turn the clock back to 21, the dollar began its parabolic, like Bitcoin rally, off the back of the first of 11 interest rate hikes. Those interest rates came up from virtually zero. Like, they were just basically zero. But as soon as those hikes started and as they continued, the dollar rallied harder and harder. what we've been seeing, though, doesn't really line up. Like, I want to say the dollar, did it pump off of June? I can't remember now. It's been too long. But the dollar rallying right now isn't super logical. It's not super logical. Don't know. I don't believe it, perhaps. This may be a good time to go over our typical, I don't want to call it a trading strategy, but our typical approach here, or how we kind of view the price action. So in general, what we see is Bitcoin, dollar stocks, all of them, they'll trend in one direction before the decision's in. So in this case, I'll say Bitcoin was trending sideways. I'll say it was trending down. I don't know. Right? And what we tend to see is a reversal until Jerome Powell speaks 30 minutes later. As soon as he opens his mouth with such high confidence, the markets just reverse. I don't know. After he's done speaking, it typically just returns basically to where it was. So what does this do? We see a whipsaw in price action where longs and shorts end up getting stopped out. And that's why I say be very careful trading today. I did say make sure you remember your stop losses. However, in the past, almost every stop loss gets hit on these because you tend to see both a swing high and a swing low, and then that frustrating return to the median. It's very bad. It's very, very bad. It's a great way to lose some money, but we don't mind that. We're a little degen here. So we did see stocks down, we did see Bitcoin down, and we did see the dollar up. So in the next, what time? There we go. My OCD gets triggered when these aren't all perfectly straight. In the next 19 minutes, I wouldn't doubt if we see Bitcoin move maybe back to its daily high, or maybe even it's 27.3. Stocks back to maybe 4,450, and then the dollar kind of back to 104.7. And then as soon as Chairman Powell speaks, we see that switch up again. I would say out of all of the years we've covered these, that has been consistent. I would say like 90% of them. There's been some wild cards, curveballs, but I'd say almost all of them. Back me up here, Chet. You can let me know. We're gonna look into Bitcoin a little bit and the dollar here before Chairman Powell speaks, but I do want to see the chat. Take profits is for dweebs. We don't like profits here. All right, bro? All right, profits? Sounds like you got an ego problem. Oh, you got a profit. All right. We just trade for the love of trading. There's no degens up in the... There's a lot of degens. We all have a piece of degen. It's just like F-Boy Friday. But today's not F-Boy Friday. What's up, BG? Domino. Zabadoo. Will Ben's new live stream cause the market to enter a bull market? Zabadoo. You guys know my opinion on Ben. You know my relationship with Ben. I can say with 100% confidence, Ben and Hit Network and BitBoy and Ben's new channel have nothing to do with a bull market or a bear market in crypto in any capacity at all. It's a Bad Baptist. OG. I did it. We did it. I don't take credit for anything here. We did it first. You guys were tuning in and nobody was watching. Nobody. I mean, we had like 100 viewers or something. But nobody was watching them. It's funny though, because the reason I covered them is I'm an old school Bitcoin guy, and we've been talking about the Fed printing the dollar into oblivion, inflation forever, 14 years. And that's why we watched the Fed. It's really interesting to me that kind of the rest of the world caught on in 21 as they increased interest rates. I did not ever expect these to be the biggest, spiciest days for us. And in reality, I used to do them, one, because I did, I thought it was important, but mostly just because it was an easy streaming day. I would just put it up and chill and like talk with you guys, and it was like kind of like a break day. Now we do them because we have to. Someone must be the champion. And that's us. That's you. All right. Do a little charts. You get 15 minutes here. You're here to play nonprofit. Oh, yeah. Who likes profit, man? Hey, think of it this way, guys. If you never profit, you can never lose. That's right. You don't have any profit to lose. A TomPow. Yeah, it was really cool. We got TomPow on again. He's been gone for a while. No one's really heard of him. Might have been off in some billionaire island somewhere. Not that one. Full degen mode. What's up, Marcin? folly more gentis. Chirpow comes along. When Chirpow comes along, he must whip it. When something good, he must whip it. 420 likes. I need my CAD. No, we don't. Oh my God. We have over 2,000 viewers. Holy boys. People are tuning in. And I don't blame them because this is a curveball. I cannot overstate that. I cannot say it enough. This is a curveball. 0 BPS after literally, it's been 2 months, so I don't know if it's just me, but my brain is a little foggy on the details. I think because it's been 2 months since the last one. They skipped August. But in my memory, I hear Chirpow saying more than once, like repeating, when people asked him, oh, well, are they going to stop? Are they going to continue rates? Him saying, we have like, that they're not done for the year. So it's just very odd. The language he used last time did not suggest this would happen. So here is the logical things we can infer from it. One, we can say, well, he's full of shit, right? We could say that, yeah, it's possible, yeah. Could just be the whole time full of shit. Possible. I admit. But number two, possibly someone found him the data. After all these meetings, the guy with the data showed up. No, that's a joke. This is a little inside joke here. Because he's always yelling, he doesn't have the data to answer any questions. When, who the hell has the data then? Like, out of anyone in the world, you should have it. But in reality, if we look at what he's been saying, his language, he says, well, we are going to do these interest rate hikes. However, and we always kind of write it off as a nothing burger, like a lame cop-out answer. But he says, however, we will continue monitoring the current like economic monetary state, and we will adjust accordingly. So here is the most logical, in my opinion, maybe factor or thing is maybe the Fed's finally seeing what they want to see. Likely that means high unemployment, crappy economy, maybe housing prices cooling. I did read something about housing prices coming down month over month for the first time in like, I don't even know, maybe ever. It must be. What do you guys think? Am I onto something, or am I just wasting time? I might be just burning some time. We'll see. We'll see. We already have 420 likes. You guys are the effing best. Holy moly. I love you. You know what? Here we go. For you guys making my day, I'm going to make 5 of your days. Lock and load. Make sure you've liked and subscribed if you'd like to receive one of these randomly gifted memberships. Gotta be subscribed, gotta have them enabled, gotta be liking, gotta be engaging with the stream. That's what YouTube says. Firing them off. Little gift. This music is not my jam. It's not bad music, but this is not my music. I need a little more EDM. A little more bass, a little more rhythm. You know what I mean? 500 likes. Guys, can we get 1,000 likes today? We have 2,400 people watching. Can we get 1,000 likes? We haven't gotten 1,000 likes, I want to say, in this quarter of the year so far. I mean, that's a lot of likes. I understand. You know, it's not easy, but I believe in you. There's over 2,000 people here. If just 500 of you pick up your mouse, put your finger on the button, click that thumbs up, we'll be right there. We'll have it. We'll have it. Gina. Gina noticed me. More likes for Gina. All right, so let's look at Bitcoin really quick here while we have just a few minutes before Chirpow. This is not bad, all right? I'm going to take us back 2 days in time to the last time we streamed. On Monday, we had a beautiful rally up to 27.5. We did see that reject off the 50 daily moving average, seen here in yellow. This was only days after the death cross on the daily, which did bring Bitcoin to a new range low before bullish engulfing on the day, rallying higher, pulling back for 2 days, and then finally testing that 50. So got to remove that. This candle right here was really not great. I did like the upside price action. I did like the green. However, we talked about this in the stream that day. I think I said it about the 200, so 27.7. But we said basically the only thing I'm worried about here, because I believe I said the 50 daily will be hit with like almost 100% certainty. The 200 daily I think is a little less certain, but I have about an 85% confidence. Okay, the problem, I'm not worried about it not hitting them. What I'm worried about is this candle right here. This I said what I don't want to see is the daily rally higher, overshoot it, and then get sold off, have a long wick on top, and close underneath the moving average. That's not what I wanted to see. It did happen. However, good news. The next day, Tuesday, yesterday, we did have a higher high, the daily pushing to a higher high versus the day before and closing just above the 50 daily. This candle pretty much did a 180 on the previous daily candle from the worst thing that I really was expecting to see to we have a close above the 50. This doesn't matter anymore. However, we're still here. We have not touched the 200 daily yet at 27.7. And so today, let's move over right here. We are opened above the 50. We have traded below the 50. And we've been bought back up. So that little dip, that little sell-off today, was that the lowest point? Was that the lowest point? Let me check. No. This was, looks like over this morning, 6 a.m. Bitcoin did trade down to 26,950. It did get bought up. And even this, so even what we saw on the interest rate decision here, this sell-off, this kind of spooky quick move, the dollar rallying higher, stocks taking a dump, even this little spooky move. Oh, shite. I didn't mean to do that. There we go. Did not push it to a new low. It did not take it below the 50 daily. That is great. I want to close, obviously green, because I want it to close green every day, but I'd like it to close above the 50 daily today, and that's going to be a beautiful sign. I would prefer to probably see the 200 daily tested, but I'll take what I can get. Closing below the 50 daily again could be bad, could be the first sign that maybe you want to bail on a long position or something. That would be an early warning sign, I would say. Let's see if I can get this to load. Probably not. Nope. Oh, that's why. Derp. There it is. Derp, da derp, derp, derp. Here we are. So to kind of simplify down on the 15, you can see we've done a little dancing here. In fact, let's zoom this out really quick. This doesn't look that bad. Actually, this looks pretty good. I hate to say it. I don't hate to say it. The 50 daily did reject price on our rally. Like I said, we hit a higher low. We came back. We rejected over and over and over again. We did close the day, but you can see visibly that price is struggling to retake this moving average. I would like to see it today again. Let's get a good close. Maybe we'll get, who knows what Chairman Powell's going to say. Because like I said a few times, for those of you just tuning in, this is kind of a wild card. Now, the markets did expect this. They were pricing it in. They were saying 98% chance of it. But that goes against what Chairman Powell said. So really, what is going to be interesting today is the reasoning. That is going to be the single most important thing that Chairman Powell says today. The reasoning behind maybe, are they abandoning their plan? Are they abandoning these, future yearly or in this year rate hikes? Are they abandoning it? Is there a reason they decided just to randomly not do this one? Oh no, my vape top disappeared. It's going to be spicy. And it's going to be important. Their reasoning could very well dictate what happens in the next, certainly in the short term, but over the next weeks, maybe even into the end of the year. It's going to be interesting. Bitcoin on the day, market cipher B, showing us money flow rolling over here. We can see our low is broken. We had that on Monday, and that money flow is reaching up to the zero line. That is a nice bullish thing to see. That is nice. I don't know what I did with that. That's not. I'll have to find it later. Solid. If we go down to the 12-hour, we have a green money flow here. Looking for this 12-hour close. So this 12-hour close actually going to be pretty important here. We see VWAP trending down. We have these two kind of beautiful rolling momentum waves. I'd like to see a third, obviously. If we do get a third, the first sign I would expect is on this 12-hour close is for that VWAP to shoot right back up, just as it did right here, right back up over the zero line and push price higher. I would love to see that. Time will tell. Let's go down really quick here, get a little bit. We only have a few minutes, about 5 minutes until Powell. 15-minute, beautiful uptrend. Money flow, higher highs. I love it. 5 minutes, a little weak here. We see lower highs in our money flow coming down. However, something of note, momentum remaining largely positive. That's not something we saw really at all last year. At all. You get rid of these MAs. There we go. One minute, a little weak as well. What can we do? What's the most important stuff? I should probably look at the dollar, huh? I'll see. We'll see if I got time. All right. That's beautiful. Right there. VWAP shooting up on the week. I love it. Momentum waning for the second week in a row, potentially on a strong close, even if it just closes here on Friday. Bullish divergence off of our lows on the week. That's been there forever. Not a lot new. Let's zoom back into our TomPow chart. Here we go. Bitcoin climbing. Doing its little climberoo. There we go. Perfect. Friendly reminder, we did just publish our first long form free educational video. Check that out after the live stream. Check it out. Watch it. Give it a thumbs up. Give it a comment. Bitcoin pretty much just following our typical FOMC price action movement, making a move on the announcement, then reversing that move until Powell speaks, and then typically reversing again, going back to the mean, leaving long and short traders kind of pissed. Typical. It's gonna bug me. How does that come off? Ah, look at that. It's my day. It's my kind of day. Thanks for the membership. Oh yeah, I didn't even see who won. XMMGX could not have happened to a better dude. Alex Wells could not have happened. Could not have given to a better dude. What's up, monkey? Bull run now. Bull run? Never ended, bruh. Shout out to our Russian friend. I can't pronounce this. I would love to shout you out, but shout out to you and all of our viewers in the beautiful country of Russia. As well as J Skippy's Entertainment. J Skippy's Entertainment. Thanks for subscribing. You are the man. Be like Jay. Be like our Russian friend. Subscribe now. There's over 2,000 people here. Certainly, we have some new viewers. Please join our fam. Hit that subscribe button, enable notifications, and then for sure jump in the Discord where you'll be able to keep up with our live streams on the daily, as well as you will get free Bitcoin airdropped to you. Sounds too good to be true. It's not. It's just not too good. I mean, you'll get some sats, but every live stream I airdrop them to the entire Discord. There's thousands of traders there with thousands of years of trading experience talking 24/7, as well as we do have a Fair Desk help chat where we have real Fair Desk employees who will give you white glove service, and if they don't, you tell me, I'll take care of it. That's my word. Worth it. You can sign up with Fair Desk. Right, meow. No KYC. All right. Enough shilling. Enough. We need to read the chat. We have just about 1 minute and 30 seconds until Powell man himself speaks. Let's adjust the volumes. Let's cut the musics. Play their weird music. Although I think I actually got like a copyright warning for playing their music once. Hit the like. That's right, monkey. What's up, CK Bull Run? Now, yes, trading Faden TradFi Indica or Sativa on that vape. This is neither. This is a nicotine vape. Remember, smoking is not cool. If you're under 18, don't ever touch it. If you're over 18, don't touch it either. Speed TA, that's right. What's up, King Peasant? 2 red ducks. Bro, it's been so long. 2 red ducks. You were here like years ago, bro. I remember your name, though. Joe Zell is hawkish for 2 reasons. The Fed is projecting another 25 BPS hike in 2023. The Fed sees 2024 EOY rate at 5.1 versus previous 4.6. Sure, that's what they said, but no interest rate hike today is not really what they were suggesting, is it? I think I might have to refresh this page. Gold is crazy. Let's pull up gold. We don't really have time, but we'll see. We'll see. It's worth a look. We have had gold up here during this before, but I don't know why. I guess it just like didn't make it. All right. Gold may be the big winner here. Let's see. Gold might be the big winner today. Haven't looked at gold in quite a bit because it's starting, but nobody's speaking yet. All right. Sure, Powell, fashionably late as always, just like TomPow. All right. Bring that up. Could be a little smaller, actually. Does anyone see Gina in the audience? There he is.
Good afternoon, everyone. My colleagues and I remain squarely focused on our dual mandate to promote maximum
No way. Whoa.
housing.
You need better servers.
Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. We've raised our policy interest rate by 5.25 percentage points and have continued to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt. Today, we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Looking ahead, we're in a position to proceed carefully in determining the extent of additional policy firming that may be appropriate. Our decisions will be based on our ongoing assessments of the incoming data and the evolving outlook and risks. I will have more to say about monetary policy after briefly reviewing economic developments.
Here we go. This is it.
Recent indicators suggest that economic activity has been expanding at a solid pace. And so far this year, growth in real GDP has come in above expectations. Recent readings on consumer spending have been particularly robust. Activity in the housing sector has picked up somewhat, though it remains well below levels of a year ago, largely reflecting higher mortgage rates. Higher interest rates also appear to be weighing on business fixed investment. In our Summary of Economic Projections, or SEP, committee participants revised up their assessments of real GDP growth, with the median for this year now at 2.1%. Participants expect growth to cool, with the median projection falling to 1.5% next year. The labor market remains tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 150,000 jobs per month, a strong pace that is nevertheless well below that seen earlier in the year. The unemployment rate ticked up in August, but remains low at 3.8%. The labor force participation rate has moved up since late last year, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. FOMC participants expect the rebalancing in the labor market to continue, easing upward pressures on inflation.
Let's go.
The median unemployment rate projection in the SEP rises from 3.8% at the end of this year to 4.1% over the next 2 years. Inflation remains well above our longer run goal of 2%. Other data, we estimate.
Dude, what is up with their servers? Can the Fed start a GoFundMe? This has like never happened.
That
like
total
this bad.
PCE prices rose 3.4% over the 12 months ending in August, and that excluding the volatile food and energy categories, core PCE prices rose 3.9%. Inflation has moderated somewhat since the middle of last year, and longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. Nevertheless, the process of getting inflation sustainably down to 2% has a long way to go. The median projection in the SEP for total PCE inflation is 3.3% this year, falls to 2.5% next year, and reaches 2% in 2026. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. As I noted earlier, since early last year, we have raised our policy rate by 5.25 percentage points. We see the current stance of monetary policy as restrictive, putting downward pressure on economic activity, hiring, and inflation. Target range for the federal funds rate.
Dude, they're streaming on a potato, but there's Gina. There's Gina. What a great place to pause. Truly blessed.
At 5.25 to 5.5%.
What the hell is this?
And to continue the process of significantly reducing our securities holdings.
They're amateur streamers.
We are committed to achieving and sustaining a stance of monetary policy that is sufficiently restrictive to bring inflation down to our 2% goal over time. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward.
Someone reboot
If the economy
Powell.
evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 5.6% at the end of this year, 5.1% at the end of 2024, and 3.9% at the end of 2025. Compared with our June summary of economic projections, the median projection is unrevised for the end of this year, but has moved up by 0.5 percentage point at the end of the next 2 years. These projections, of course, are not a committee's decision or plan. If the economy does not evolve as projected, the path of policy will adjust as appropriate to foster our maximum employment and price stability goals. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. Given how far we have come, we are in a position to proceed carefully as we assess the incoming data and the evolving outlook and risks. Real interest rates now are well above mainstream estimates of the neutral policy rate, but we are mindful of the inherent uncertainties in precisely gauging the stance of policy. We're prepared to raise rates further if appropriate, and we intend to hold policy at a restrictive level until we're confident that inflation is moving down sustainably toward our objective. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Reduce.
Dude. You'd think like maybe this is an important
back
thing.
Down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Gina, shut up, everybody. Gina, just Gina. Only Gina.
Thank you. Colby Smith with the Financial Times. What
No,
makes
you're
the
not, Gina.
committee inclined to think that the Fed funds rate at this level is not yet sufficiently restrictive, especially when officials are forecasting a slightly more benign inflation outlook for this year? There's noted uncertainty about policy lags. Headwinds have emerged from the looming government shutdown, the end of federal childcare funding, resumption of student debt payments, things of that nature.
Yes.
So I guess I would characterize the situation a little bit differently.
He seems nervous.
So we decided to maintain the target range for the federal funds rate where it is at 5.25% to 5.5%, while continuing to reduce our securities holdings. And we say we're committed to achieving and sustaining a stance of monetary policy that's sufficiently restrictive to bring down inflation to 2% over time. We said that. But the fact that we decided to maintain the policy rate at this meeting doesn't mean that we've decided that we have or have not at this time reached that stance of monetary policy that we're seeking. If you looked at the SEP, as you obviously will have done, you will see that a majority of participants believe that it is more likely than not that it will be appropriate for us to raise rates one more time in the 2 remaining meetings this year. Others
Then what does it
believe
mean?
that we have already reached that. So it's something where we're not making a decision by deciding to about that question by
He's
deciding to
nervous.
just maintain the rate and await further data.
You
So
told us what it
right
doesn't
now,
mean.
it's still an open question about sufficiently restrictive. You're not
What does
saying
it mean?
today that we've reached this level.
Uh-oh,
We're
we got
not
the
saying,
dumps.
no, clearly we are just, what we decided to do is maintain the policy rate and await further data. We want to see convincing evidence, really, that we have reached the appropriate level. And
The
you know,
data.
we're seeing progress, and we welcome that. But, we need to see more progress before we'll be willing to reach that conclusion.
And just on the 2024 projections, what's behind that shallower path for interest rate cuts and the need for real rates to be 50 basis points higher?
Right. So I would say it this way. First of all, interest rates, real interest rates are positive now. They're meaningfully positive. And that's a good thing. We need a policy to be restrictive so that we can get inflation down to target, okay? And we're going to need that to remain to be the case for some time. So I think, remember that of course, the SEP is not a plan that is negotiated or discussed really as a plan. It's accumulation, really, and what you see are the medians. It's accumulation of individual forecasts from 19 people, and then what you're seeing are the medians. So I wouldn't want to, bestow upon it the idea that it's really a plan. But what it reflects, though, is that economic activity has been stronger than we expected, stronger than I think everyone expected. And so what you're seeing is this is what people believe as of now will be appropriate to achieve what we're looking to achieve, which is progress toward our inflation goal, as you see in the SEP.
Thanks. Let's go to Rachel.
Thanks. He said what it doesn't mean. Why did he not say what it does mean?
Hi, Chair Powell. Rachel Siegel from the
Chair
Washington
Powell.
Post.
She
Thanks
said
for
it.
taking our questions.
Chair Powell.
How would you characterize the debate around
Lots of
another hike
cuties on
or
here.
holding steady? Is it discussion around lag times, fear of too much slowing, too little slowing? Could you walk us through what this disagreement was about at the meeting?
Can Gina talk?
Yeah, so the proposal at the meeting was to maintain our current policy stance. And I think there was obviously unanimous support for that. But this, of course, is an SEP meeting, and so people write down what they think. And you have some, you saw, I think 7 wrote down no hike at this meeting, or between now and the end of the year, and I think 12 wrote down another single hike in one of the next 2 meetings that we have between the end of the year. So it wasn't like we were arguing over that, people just stating their positions. And really what people are saying is, let's see how the data come in. We want to see, what we want to see. We want to see that these good inflation readings that we've been seeing for the last 3 months, we want to see that it's more than just 3 months, right? We want to see, the labor market report that we received, the last one that we received, was a good example of what we do want to see. It was a combination of across a broad range of indicators, continuing rebalancing of the labor market. So those are the 2 things. Those are our 2 mandate variables, and that's the progress that we want to see. But I think people, they want to be convinced. They want to be careful not to jump to a conclusion really one way or the other. but just be convinced that the data, support that conclusion. And that's why, given how far we've come and how quickly we've come, we're actually in a position to be able to proceed carefully as we assess the incoming data and the evolving outlooks and risks and make these decisions meeting by meeting.
I see. And in your view, I know nothing has been decided yet, but what would one more hike at the end of the year do to the economy or to inflation? And on the other side, what would no hike do, if you could sort of game that out for us?
So, you can make the argument that one hike one way or the other won't matter, but for us, we're trying, obviously as a group, it's a pretty tight cluster of where we think that policy stance might be, but we're always going to be learning from data. We've learned all through the course of the last year that actually we needed to go further than we had thought. If you go back a year and what we wrote down, it's actually gotten higher and higher. So we don't really know and that's why, again, we're in a position to proceed carefully at this point. A year ago, we proceeded pretty quickly to get rates up. Now we're fairly close, we think, to where we need to get.
You can't get a sentence out without
It's just a question of reaching the right stance. I wouldn't attribute huge importance to one hike in macroeconomic terms. Nonetheless, we need to get to a place where we're confident that we have a stance that will bring inflation down to 2% over time. That's what we need to get to, and we've been moving toward it. As we've gotten closer to it, we've slowed the pace at which we've moved. I think that was appropriate. And now that we're getting closer, we have the ability to proceed carefully.
Who has the data, Gina? Could you answer, please, Gina?
Steve Leisman, CNBC.
No,
Mr.
you're
Chair,
not.
I want to return
Get out of
to
here,
Cole's
Steve.
question here.
Yeah, get out of here.
What is it saying about the committee's view of
This
the
guy. I like this guy.
inflation dynamic in the economy that you achieve the same forecast inflation rate for next year, but need another 0.5 point of the funds rate on it? Does it tell us that the committee believes inflation to be more persistent,
He's gonna say
requires
no.
more medicine effectively? And I guess a related question is, if you're going to project a funds rate above the longer run rate for 4 years in a row, at what point do we start to think, hey, maybe the longer rate or the neutral rate
There's
is
their
actually
ponytail.
higher? Thank you.
So
No, I wouldn't say that. That's what he's going to say.
I guess I
wouldn't
would
say that.
point more to, rather than pointing to a sense of inflation having become more persistent, I wouldn't think that's not, we've
Yeah, I wouldn't
seen
think that.
inflation be more persistent over the course of the past year, but I wouldn't say that's something that's appeared in the recent data. It's more about stronger economic
He's got the
activity, I
data.
would
This
say.
man's got the
So,
data. He talks about it all the time.
If I had to attribute one thing, again, we're picking medians here and trying to attribute one explanation, but I think broadly, stronger economic activity means rates. We have to do more with rates, and that's what that meaning is telling you. In terms of
We have to do
what the
more
neutral rate can be, we know it by its works. We only
Potato stream, chirp pows on a potato stream. They're just the federal government. They don't have good internet.
In terms of,
It's not me.
what the neutral rate can be, we know it by its works.
I wouldn't
We
say
that
that.
the neutral rate has risen. You do
I would
see
say.
people. You don't see the median moving, but you do see people raising their estimates of the neutral rate, and it's certainly plausible that the neutral rate is higher than the longer run rate. Remember, what we write down in the SEP is the longer run rate. It is certainly possible that that the neutral rate at this moment is higher than that, and that's part of the explanation for why the economy has been more resilient than expected.
Let's go to Howard.
Howard Schneider with Reuters. Thank you.
Who are all these
So you said several
non-Gina
times
people?
that the economy needed a period of below-trend growth to get inflation consistently back to 2%. You kind of get that in 2024, a little bit. 1.5% is just a touch below what's the estimate of potential. So the fact that you're getting so much done at so much less cost, does that represent a change in how you think inflation works, a change in how you
hair's
think
so
the economy
soft.
works, a change in the mix of supply healing versus demand destruction that's necessary to achieve this?
Yes, of course, it is a good thing that we've seen now
said the
meaningful
word
rebalancing
yes for the
in the
first
labor
time ever
market
right now, by
without
the way.
an increase in unemployment, and that's because we're seeing that rebalancing in other places, in, for example, job openings. and in
Potatoes,
the
Yobo.
jobs worker gap. You're also seeing supply side things. So that's happening. I would say, though, I still think, and I think broadly, people still think that there'll have to be some softening in the labor market that can come through more supply, as we've seen as well. Also, remember, the natural rate we think is coming down, which is a supply side thing, so that the gap between any given unemployment rate that's lower than that and the natural rate comes down. That's a way for supply. That's a way for the labor market to achieve a better balance. So all of those things are happening. You're right. In the median forecast, we don't see a big increase in unemployment. We do see an increase. And but that really is just playing forward the trends that we've been seeing. That is not guaranteed. There may come a time when unemployment goes up more than that, but that's really what we've been seeing, is progress without higher unemployment for now.
So just to boil that
Maybe
down for a
it
second,
doesn't matter,
we've gone
Chair
from
Powell.
a very narrow path to a soft landing to something different. Would you call the soft landing
I like
now,
this guy. He's a wild
baseline
card. Wild card.
expectation?
It's all jittery.
No, I would
What
not
was
do that. I would just say, what would I say about that?
What would I say?
I've
about
always
that?
thought that the soft
do you
landing
think?
was a plausible outcome, that there was a path, really, to a soft landing. I thought that, and I've said
Bullshit.
that since we lifted off.
Bullshit.
It's also possible that
We
the
did.
path has narrowed and it's widened, apparently. Ultimately, this may be decided by factors that are outside our control at the end of the day. But I do think it's possible. And, you know,
I think it's.
I also think,
I also think about
you know,
Tamagotchis sometimes.
this is why we're in a position to move carefully again, that we will restore price stability. We know that we have to do that, and we know the public depends on us doing that, and we know that we have to do it so that we can achieve the kind of labor market that we all want to achieve, which is an extended period, sustained period of strong labor market conditions that benefit all. We know that. The fact that we've come this far lets us really proceed carefully, as I keep saying. So I think, you know, that's the end we're trying to achieve. I wouldn't want to handicap the likelihood of it, though. It's not up to me.
Mr. Chair Powell, how many licks to the center of a Tootsie Pop?
Nick Timmeros of the Wall Street Journal. Chair Powell, both you and Vice Chair Williams
Powell.
have indicated that sufficiently
Powell.
restrictive will be judged on a real rather than nominal basis, implying some scope for nominal rate cuts next year, provided further compelling evidence that price pressures will continue to subside. Is the FOMC focused on targeting a real level of policy restriction? And can you explain what would constitute enough evidence that will allow the FOMC to normalize the nominal stance of policy while keeping real policy settings sufficiently restrictive?
Sorry, Nick, can't do it. Next
Yes,
question.
we understand that it's a real rate that will matter and that it needs to be sufficiently restrictive. Again, I would say you know sufficiently restrictive only when you see it. It's not something you can arrive at with confidence in a model or in various estimates, you know. And so what are we seeing? We're seeing, you know, through a combination of the unwinding of the pandemic-related demand and supply distortions and monetary policy's work in suppressing demand or alleviating very high demand. The combination of those two things is actually working. You're seeing, you know, inflation coming down. It's principally now in goods, also in housing services. You begin to see effects of it in non-housing services as well. So we think that is working. And I think what, you know, as we've said, we want to reach that. We want to reach something that we're confident it gets us to that level. And I think confidence comes from seeing, you know, enough data that you feel like, yes, okay, this feels like we can for now decide that this is the right level.
How much
and
data
just
is
agree to
enough
stay
data?
here. We're not permanently deciding not to go higher, but we would, let's say, if we get to that level. And then the question is, how long do you stay at that level? And that's a whole other
You're
set of
supposed
questions.
to
For
have
now, the
these
question
answers.
is trying to find that level where we think we can stay there. And we haven't gotten to a point of confidence about that yet.
And it froze. Sorry to interrupt. So if you don't know these answers, who knows these answers? You're the only guy in the world whose job is to know these
PCE
answers.
inflation could come in even lower than the median at 3.7. would you see a case to raise rates still if it turned out that you were going to achieve the same real rate this year because the decline in inflation proceeds somewhat better than you currently anticipate?
The decision that we make at each meeting, and certainly at the last two meetings this year, it's going to depend on the totality of all the data. So the inflation data,
Okay,
the
now it's
labor
the
market data, the
totality.
growth data, the balance of risks and the other events that are happening out there. We take all of that into account. So I can't really answer a hypothetical about one piece of that. It'll be trying to reach a judgment over whether we should move forward with another rate hike overall, and whether that would increase our confidence that yes, this is an appropriate move, and it will help us be more confident that we've gotten to the level that we need to get to.
Gina?
Shut up! Everybody shut up. It's Gina. Shut up.
Thanks, Chair Powell.
Ooh, she's
Following
so
up
cute
on Nick's
sounding.
question, actually, John Williams, the New York Fed president, obviously, has said things to the effect of next year, as we see inflation, kind of, again, to Nick's point, as we see inflation coming down, we're going to need to reduce interest rates to make sure that we're not squeezing the economy harder and harder over time. And I wonder if that's basically the logic that you apply. Is that how you think about it? And then I also wonder, in the last press conference, you said something to the effect of, it's a full year out, those discussions, and people
Well,
interpreted
forward of you,
that to
Gina.
mean that you didn't see a possibility of a rate cut in the first half of next year. And I wonder if that was what you meant by that, or whether, how you're thinking about that timing.
No, when I answer these questions about hypotheticals about cutting, I'm never intending to send a signal about timing. I'm just answering them as the question is expressed. So
I'm never
so
intending
please,
them to be helpful.
I wouldn't want to be taken that way. Sorry, the first question was, is that how? Yeah, so we're as we go into next year, that's the question we'll be asking is, taking into account lags and everything else we know about the economy and everything we know about monetary policy. The time will come at some point, and I'm not saying when, that it's appropriate to cut.
Won't tell.
Part of that may be that real rates are rising because inflation is coming down. Part of it just may be that it'll be all the factors that we see in the economy. And, that time will certainly come at some point. And what you see is us writing down, a year ahead estimates of what that might be. And, there's so much uncertainty around that. When we, in the moment, we'll do what we think makes sense. No one will look back at this and say, hey, we made a plan. It's not like that at all. These are estimates made a
have
year
a
in advance
plan?
that are highly uncertain, and that's how it is.
Neil?
Guys, really quick. Doesn't it kind of sound like Chair Powell is like a high school student giving a speech? He has no answers. He just repeats other people's questions.
Versus supply side factors, productivity, labor force growth. And relatedly, if GDP keeps coming in hot, even in the absence of inflation
Hot as
resurgence,
Gina.
would that on its own be a reason to consider more tightening?
She looks so good.
So on your first question, I mean, we're looking at GDP very, very carefully to try to understand really what's the direction of it, what's driving it, and it's a lot of consumer spending. The consumer's been very robust in spending. So that is, that's how we're looking at it.
Yeah, no.
Sorry,
we
your
don't.
second question was?
You know. You're
GDP
supposed to know.
stays hot, but without inflation.
So I think the question will be, GDP is not a mandate, right? Maximum employment and price stability are the mandates. The question will be, is GDP, is the heat that we see in GDP, is it really a threat to our ability to get back to 2% inflation? That's going to be the question. It's not a question about GDP on its own. It's you're expecting to see this improvement, continued rebalancing in the labor market and inflation moving back down to 2% in a sustainable way. We have to have confidence in that, and we'd be looking at GDP just to the extent that it threatens one or both of those.
Victoria?
How about you answer a question instead of just
Hi,
saying
Victoria
what the
Guida with
question
Politico.
is or should be?
There are multiple external factors that are playing out right now. We see rising oil prices. We see auto workers striking. There's the looming, very real possibility of a government shutdown. And I was just wondering, for each of those things, could you talk about how you're thinking about how that might affect the course for the Fed and the economy?
So there is a long list, and you hit some of them. But it's the strike, it's government shutdown, resumption of student loan payments, higher long-term rates, oil price shock, there are a lot of things that you can look at. And, so what we try to do is assess all of them and handicap all of them. And ultimately, though, there's so much uncertainty around these things. I mean, to start with the strike, first of all, we absolutely don't comment on the strike, as we have no view on the strike one way or the other, but we do have to make an assessment of its economic effects to do our jobs. So, the thing about it is so uncertain. It will depend. The economic effects, it could affect, we've looked back at history, it could affect economic output, hiring, and inflation, but that's really going to depend on how broad it is and how long it's sustained for. And then it also depends on how quickly production can make up for lost production. So none of those things are known right now. It's very, very hard to know. So you just have to leave that uncertain, and we'll be learning, I think, over the course of the next intermeeting period. Comment on that. It hasn't traditionally had much of a macroeconomic effect. Energy prices being higher, that is a significant thing. Energy prices being up can affect spending. It can affect over time. A sustained period of higher energy prices can affect consumer expectations about inflation. We tend to look through short-term volatility and look at core inflation. But so the question is, how long are higher prices sustained? We have to take those macroeconomic effects into account as well. Those are some of them. I'm not sure if I hit them all, but ultimately, you're coming into this with an economy that appears to have significant momentum, and that's what we start with. But we do have this collection of risks that you mentioned.
Craig Torres from Bloomberg News. I was a little surprised, Chair Powell, to hear you say that a soft landing is not a primary objective. This economy is seeing added supply in a way that could create long-term inflation stability. We have prime-age labor force participation moving up where people can add skills. Workers want to work. We have a boom in manufacturing construction. We've had a decent spate of home building. And since inflation's coming down with strong GDP growth, we may have higher productivity. All are which good for the Fed's longer run target of low inflation. And if we lose that in a recession, aren't we opting for the awful hysteresis that we had in 2010? So are you taking this into account as you pursue policy? Thank you.
To begin, a soft landing is a primary objective, and I did not say otherwise.
Okay. All right.
I mean, that's what we've been trying to achieve for all this time. The real point, though, is the worst thing we can do is to fail to restore price stability, because the record is clear on that. If you don't restore price stability, inflation comes back, and you go through, you can have a long period where the economy is just very uncertain, and it'll affect growth, it'll affect all kinds of things. It can be a miserable period to have inflation constantly coming back and the Fed coming in and having to tighten again and again. So the best thing we can do for everyone, we believe, is to restore price stability. I think now, today, we actually, we have the ability to be careful at this point and move carefully, and that's what we're planning to do. So we fully appreciate the benefits of being able to continue what we see already, which is rebalancing in the labor market and inflation coming down without seeing, an important, large increase in unemployment, which has been typical of other tightening cycles. So.
Let's go to Chris.
Hi, thank you. Chris Rugaber at Associated Press. When you look at the disinflation that has taken place so far, do you see it mostly as a result of what some economists are calling the low-hanging fruit, such as the unwinding of supply chain snarls and other pandemic disruptions, or is it more a broad disinflationary trend that involves most goods and services across the economy? Thank you.
So if I understood your question, I would say it this way. I think we knew from before when we lifted off, but certainly by the time we knew that bringing inflation back down was going to take, as I call it, the unwinding of these distortions to both supply and demand that happened because of the pandemic and the response. So that unwinding was going to be important. In addition, monetary policy was going to help. It was going to help supply side heal by cooling demand off. and just in general, better aligning supply with demand. So those two forces were always going to be important. I think it's very hard to pull them apart. They work together. I do think both of them are at work now, and I think they're at work in a way that shows you the progress that we are seeing.
Go to Mike.
Michael McKee from Bloomberg Television and Radio.
It's embarrassing. It's embarrassing. I got like residential internet through a
What would
coax
justify
cable.
that
Better
last
than
move?
their
Because
internet.
the median forecast is for lower inflation. And
Well, forecasts are highly uncertain.
Unwatchable. as
Forecasting
if
is
it
very
already wasn't.
difficult. Forecasters are a humble lot with much to be humble about. Higher rates. Unemployment,
I got to pause it for a second. Look at that beautiful mug. He's taking a breather. Somebody reboot him. Have you tried turning him on and off again?
But to get to your question, though, what's happened is growth has come in stronger, right? Stronger than expected, and that's required higher rates. Unemployment, you also see that the ultimate unemployment rate is not as high, but that's really because of what we've been seeing in the labor market. We've seen more and more progress in the labor market without seeing significantly higher unemployment. So we're continuing that trend.
Why
In
do
terms
you
of
need
inflation, you are seeing the last three readings are very, very good readings. It's only three readings. We were well aware that we need to see more than three readings. But if you look at June, July, and August, you're looking at really significant declines in core inflation, largely in the goods sector, also to some extent in housing services, and just
You're
a
wearing a
little
lot of
in
makeup.
non-housing services. Those are the three buckets. Headline inflation, of course, has come way down, largely due to lower energy prices, some of which is now reversing. So I think people should know that economic forecasting is very difficult, and these are highly uncertain forecasts. But these are our forecasts. We have very high quality people working on these forecasts, and I think they stand up well against other forecasters. But just the nature of the business is the economy is very difficult to forecast.
given the forecast that you have, what justified not moving today, and what could justify moving in the future if you think?
Well, I think it's important at the beginning that we move quickly, and we did. And I think as we get closer to the rate that we think the stance of monetary policy that we think is appropriate to bring inflation down to 2% over time, the risks become more two-sided. And the risk of over-tightening and the risk of under-tightening becomes more equal. And I think that the natural common sense thing to do is as you approach that, you move a little more slowly as you get closer to it. And that's what we're doing. So we're taking advantage of the fact that we have moved quickly to move a little more carefully now as we sort of find our way to the right level of restriction that we need to get inflation back down to 2%.
Jennifer.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. With your focus on year-over-year PCE, isn't it true that base effects are huge, and that by the time you meet in November, that it's more likely that you'll have a low PCE number that would make you feel more comfortable? And secondly, how would the lack of key indicators like CPI, the jobs report, impact your approach in upcoming meetings if we were to have a government shutdown? Thank you.
Yeah, I missed the first question. What was it? What factors?
Sorry, I was
The
staring at
base
your beautiful
factors.
face.
Base factors.
She's cutie too. There's a lot of cuties now. I'll take that change.
So
I like that.
On that, we're looking at just monthly, right? You can look at just monthly readings and see what the increase was from the prior month. So you're right. When you go back 3, 6, and 12 months, you can base
1,000
factors,
likes.
but we can adjust for that. In terms of not getting data, again, we don't.
Data, there it is, Tillin.
We don't comment on government shutdowns. It's possible if there is a government shutdown and it lasts through the next meeting, then it's possible we wouldn't be getting some of the data that we would ordinarily get.
They won't be getting the data, guys.
We would just have to deal with that, and I don't know. It's hard for me to say in advance how that would affect
catastrophic
that meeting. It would depend on all kinds of factors that I don't know.
If they don't
right now,
get
but
the
it's
data,
certainly a reality that's a possibility.
they'll probably just be like right now, and they don't have the data. No change.
As those kind of fall out of the equation for the next couple of readings by November, would you feel more comfortable at that point?
Yes. I mean, if you're looking, if we can tell how much inflation has gone up in a given month, right?
Okay.
And
have
that's
the
what we're
data.
looking at. And month by month, what's the reading? And I think what we're really looking at is there's a tendency to look at shorter and shorter maturities, but they're incredibly volatile and they can be misleading. That's why we look at 12-month. But I think in this situation where it looks like we've had a bit of a turn in inflation starting in June, we're also looking at 6 months and even 3 months, but really 6 months inflation. So you're looking at it over that period and over longer periods. That's the right way to go. And we don't need to be in a hurry in getting to a conclusion about what to do. We can let the data evolve.
Evolve the data? That's brilliant.
Thanks for the question, Chair Powell.
Brilliant.
Edward Lawrence with Fox Business. So I want to focus back in on oil prices.
Yeah,
we're seeing
flying.
oil prices, as you mentioned, move up, and that's
Flying.
pushing the price of gas. So how does that factor into your decision to raise rates or not? Because the last two inflation reports, PCE and CPI, we've seen the overall inflation has actually risen.
Right. So
wouldn't say that.
energy prices are very important for the consumer. This can affect consumer spending. It certainly can affect
He didn't
consumer
ask you
sentiment,
that.
and gas prices are one of the big things that affects consumer sentiment. It really comes
else?
down to how persistent, how sustained these energy prices are. The reason why we look at core inflation, which excludes food and energy, is that energy goes up and down like that, and it doesn't. Energy prices mostly don't contain much of a signal about how tight the economy is, and hence don't tell you much about where inflation's really going. However, we're well aware, though, that if energy prices increase and stay high, that'll have an effect on spending, and it may have an effect on consumer expectations of inflation, things like that. That's just
No
things
way.
we have to monitor.
No way.
So.
On the consumer, they're putting more and more of this on their credit card. The consumer seeing record credit spending. How long do you think the consumer can manage that debt at higher interest rates now?
Forever.
And are you concerned about a debt bubble related to that?
So, to finish my prior thought, I was saying that's why we tend to look through energy moves that we can see as short-term volatility. Turning to consumer credit, of course we watch that carefully. Consumer distress, measures of distress among consumers were at historic lows quite recently. During and after the pandemic. They're now moving back up to normal. We're watching that carefully, but at this point, these readings are not at troublingly high levels. They're just kind of moving back up to what was typical in the pre-pandemic era.
Evendra Babu. What a champ.
Hi, Jean Young with M&I Market
Jean
News.
Young. Jean Young.
Yields along the Treasury curve have risen to their highest
It's
in
like
years.
all ladies.
What is
I
the
like
Fed's
it.
view about what's been driving that increase in recent weeks? And how much of it can be attributed to macro explanations and how much to technical factors?
So you're right. Rates have moved up significantly. I think it's always hard to say precisely, but most people do a common decomposition of the increase, and the view will be it's not mostly about inflation expectations. It's mostly about other things. Either term premium or real yields, and it's hard to be precise about this. Of course, everyone's got models that'll give you a very precise answer, but they give you different answers. So, but essentially, they're moving up because it's not because of inflation. It's because it'll probably have something to do with stronger growth.
Probably.
I would say more supply of treasuries. The common explanations that you hear in the markets kind of make sense.
Probably. Thank you. That was very informative.
Kyle Campbell, American Banker. Thank you for taking the questions. Just two on housing. You've said slower shelter cost growth is in the pipeline and will reflect in inflation readings as new leases are signed. But there's also some questions out there about the way housing costs are measured, particularly the use of rental equivalents, which are estimates from homeowners about what their homes would rent for if they were in the rental market. So my question is, how much of the effort to tame inflation, both as it's measured and felt by the broader public, hinges on housing supply. And then as far as a constrained housing supply being sort of exacerbated by this sort of lock-in effect of mortgages being higher now than they were at their
Dollar
recent
breaking
historic
its high.
lows, how is that going to impact future thinking about taking interest rates to that lower bound in the future?
So on the supply point, of course, supply is very important over time in setting house prices and for that matter, rents. And supply is kind of structurally constrained. But in terms of where inflation's going in the near term, though, as you obviously know, a lot of it is leases that are running off and then being re-signed or released at a level that's not it won't be that much higher. It would have a year ago it would have been much higher than it was a year before. Now it may be below or at the same level. So as those leases are rolling over, we're seeing what we expect, which is measured housing services inflation coming down. Your second question was the lock-ins. How much is that affecting things, really?
Is that going to affect your decisions to potentially bring rates down to their lower bound in the future, sort of creating that sort of bubble of buying and then a lock-in that sort of stagnates the housing market?
I think we look at I would look at the lock-in.
Would you?
The idea being that people are in very low rate mortgages, and
I would not invest in any internet because we're the Fed and we're not talking to the whole world right now. Jeebus.
The idea being that people are in very low rate mortgages, and roll in our future decisions in a future loosening cycle about whether we would cut rates. No, I don't think it would. I mean, I don't think that's. Gas. I think we'd be looking at what fundamentally what rates does the economy need, and in an emergency like the pandemic or during the global financial crisis, you have to cut rates to the point that you have to do what you can to support the economy. So I wouldn't think that would be a reason for us not to do that. It's not something we're thinking about at all right now, but down the road I wouldn't think so.
Nancy. It's like
Nancy Marshall-Genser
80% women
Marketplace.
asking questions.
Chair Powell, you've mentioned several things that would possibly
Chair
weigh
Powell.
on consumer confidence, maybe cut back consumer spending, possible government shutdown, high gas prices. At this point, would the Fed welcome a decrease in consumer spending? Would that help you get inflation closer to your 2% target?
I wouldn't say that.
I wouldn't say it that way. We're not looking for a decrease in consumer spending. It's a good thing that the economy is strong. It's a good thing that the economy has been able to hold up under the tightening that we've done. It's a good thing that the labor market's strong. The only concern, and it just means this: if the economy comes in stronger than expected, that just means we'll have to do more in terms of monetary policy to get back to 2%, because we will get back to 2%. Does that answer your question?
Yeah, and I guess on the other hand, would you worry that that could contribute to an economic slowdown or even a recession?
I wouldn't say that.
Well, that's always a concern. Concern number one is restoring price stability, because in the long run, that's something we have to do so that we can have the kind of economy we really want, which is one with sustained period of tight labor market conditions that benefit all, as I've said a couple times. So that said, of course, we also now, given how far we've come with our rate hikes and how quickly we've come here, we do have the ability to be careful as we move forward because of that consideration.
Came real fast.
Thank you, Chair Powell. Simon Rabinovich with The Economist. One of the factors in the economic resilience to date appears to be a lesser degree of rate sensitivity than in the past. Obviously, we've talked about households with long fixed-rate mortgages, also companies that refinanced before last year. What is your thinking about the efficacy of rates and how that's changed? And then related to that, how do you think about the distributional consequences in the sense that if you're a relatively wealthy household with a long fixed-rate mortgage, the past year has not been all that tough with rates going up, whereas if you're relying on your credit card for supporting your consumption, in fact, times are getting a lot tougher, a lot more quickly. Thanks.
So why?
Gnarly.
I guess it's fair to say that the economy's been stronger than many expected, given what's been happening with interest rates. Why is that? Many candidate explanations. Possibly a number of them make sense. One is just that household balance sheets and business balance sheets have been stronger than we had understood, and so that's spending is held up and that kind of thing. We're not sure about that. The savings rate for consumers has come down a lot. The question is whether that's sustainable. It could just mean that the date of effect is later. It could also be that for other reasons the neutral rate of interest is higher for various reasons. We don't know that. It could also just be that policy hasn't been restrictive enough for long enough.
What do you know?
And there are many candidate explanations. We have to, in all this uncertainty, make policy. And I feel like what we have right now is what's still a very strong labor market.
Not a very strong internet connection. Jeez. This is the worst
That's
it's ever
where we
been.
are, and we have to deal with what comes. On your second question,
We came
which
fast
was,
and we gotta
sorry,
deal
your
with
second
what
question was
comes.
distributional, but can you be a little clearer about that?
Yeah, my point there was that if you're somebody who has a long fixed rate mortgage, you've been able to endure the higher rates relatively easily. If you're somebody who's living month to month off of your credit card, current financing rates are punitive.
Yes, and so the point I would make there is that we're trying to get inflation back down. The people who are most hurt by inflation are the people who are on a fixed income. If you're a person who spends all of your income,
and yet we want them to lose their jobs.
You don't really have any meaningful savings. You spend all your income on the basics of life: clothing, food, transportation, heating, the basics. And prices go up by 5, 6, 7%. You're in trouble right away. Whereas even middle class people have some savings and some ability to absorb that. So it is for those people, as much as for anybody, that we need to restore price stability. And we want to do it as quickly as possible. Obviously, we would like to do that. We'd like the current trend to continue, which is that we're making progress without seeing the kind of increase in unemployment that we've seen in past things. But you're right, though. When we raise rates, people who are living on credit cards and borrowing are going to feel that more. They are, and of course, people with lots of savings also have a much lower marginal propensity to consume, and so they're not going to. It's not going to affect them as much.
No, it won't even affect them then. Okay.
Let's go to Greg Robb for the last question.
Let's go to Greg. For the last question, she laid the law
Thank
down.
you, Chair Powell.
Greg
Robb from Market Watch.
That's Pow to you, Market Watch.
In the Beige Book recently, you can tell that the Fed has been surveying nonprofits and community groups about the economic health of low-income Americans, moderate-income Americans. I have two questions about this. Are you going to use that data to maybe come up with sort of like a quarterly survey of those groups, like the Senior Loan Officer Survey? And also the second question is, from your recent readings of these surveys, how are low and moderate Americans doing? Is there this thing where the GDP is strong because of wealthy Americans kind of driving things? And just want to get your sense of the health of that sector. Thank you.
So I don't know about the quarterly survey. That's an idea we can take away and think about. In terms of how low and moderate Americans, they're clearly were suffering from high inflation. I think during the pandemic, the government transfers that happened were very meaningful. And if the surveys that we take showed that low and moderate income people were actually in very, very strong financial condition. I think now it's a very hot labor market, and you're seeing high nominal wages, and you're starting to see real wages are now positive by most measures. So I think overall households are in good shape. Surveys are a different thing. So surveys are showing dissatisfaction, and I think a lot of that is just people hate inflation, hate it. And that causes people to say the economy is terrible, but at the same time, they're spending money. Their behavior is not exactly what you would expect from the surveys. That's kind of a guess at what the answer might be. But I think there's a lot of good things happening on household balance sheets, and certainly in the labor market and with wages. The biggest wage increases having gone to relatively low-wage jobs, and now inflation coming down, you're seeing real wages, which is a good thing. Thanks very much.
Let's see. That was the last question. No. I want to ask you a question. Have you gotten a raise in the last year? Have you gotten a raise? Yes, this year. Yes. Since COVID. Yep, since COVID. Yeah, it's great. Nope. All right, real quick. No raise, no job, no raise, no job, no. Ooh, Fujita Jablus got a raise. Well, shout out to you, my friend. Alec, Louisiana got a raise. Tillin got a raise. Randy got a raise. You get a raise. You get a raise. You get a raise. We all get raises, apparently, says Chirpow. That was not as interesting as I'd hoped. Let's recap really quick here. The dollar showing some very spicy strength off of the no interest rate hike. It did blast off to a high and retraced, but then since has broken that high, looking pretty strong. Bitcoin, on the other hand, kind of the opposite picture going on. I put this here, I don't know if you saw it, but essentially when the interest rate came out, so at like 159 and 59 seconds, Bitcoin was directly at the 50 daily moving average, directly, like exactly right here, that open, directly. During that speech, it did do pretty much what we always expected to do. It trended down, the interest rate decision came in, it moved up, it reversed, Powell started speaking, and we dumped. Typically, we just expect it to return to the median. This time, it went farther. Like I said, maybe 90% of the time, that's what happens. Stocks also seeing some downside, but not quite as extended as Bitcoin, losing some of their ground here today. I want to say down 1% on the speech. All right, not bad. Overall, that was fun. Thank you guys. I love these. We didn't have one last month, but there is one next month, so we'll be here in November. But we are live here Monday, Wednesday, Friday, sometimes in between, and you should be joining for those too. When there's nothing spicy going on, we're usually just chilling and charting and hanging out. Join the fam, hop in Discord, sign up with Fairdesk and Femex, no KYC, start trading today. Start trading today. Also, last thing, guys, last thing. Check out this new long form video. Give it a like, give it a comment, watch the whole thing, let it play through, help manipulate the algorithm. There's the link. We'll be live again Friday, fam. Hopefully Bitcoin rebounds from here, but time will tell. I love you all. Gina, notice me, senpai. Gina. I love you, Gina. And I love all of you, especially the people who subscribed. You guys rock.